Welcome back, everyone. This week reminded investors how fast trade headlines can hit and reverse, sending markets on a sharp emotional roller coaster. Sudden tariff threats rattled confidence, and the quick pullback only reinforced how fragile visibility really is. This chart captures how violently trade policy uncertainty reacted to tariff headlines over the past 2 years. Both the EPA trade and EMV trade policy risk measures show sharp jumps around sudden announcements, followed by fast pullbacks once rhetoric cooled. That stop and start pattern is exactly what rattled markets this week, because it signals policy risk that is unpredictable rather than persistent. Investors can live with bad news, but they struggle with news that changes overnight. The recent spike stands out as elevated relative to most of 2024, reinforcing why risk assets hesitated even after tariffs were walked back. In short, the chart shows that it was not the tariffs themselves, but the volatility of the message that forced markets to constantly reprice risk. Davos turned into a live stress test for global confidence, with leaders openly debating trade, security, and how stable the international order really is. The mood was basically, growth may be holding up, but politics is injecting a fresh volatility premium into everything. And when European leaders and Ukraine pushed back hard on the Greenland pressure campaign, it reinforced that global cooperation is not a given right now. So what does this mean for us? Even if the macro data is steady, geopolitics can still swing sentiment fast. Japan became another source of anxiety as government bond yields jumped, and policymakers signaled close monitoring. That move forced global investors to reassess where the next rate shock could emerge and reminded markets that Japan rarely stays a local story. This chart highlights how Japanese and US 10-year yields moved in tandem until Japan suddenly broke higher. The sharp rise in Japan's 10-year yield narrowed the long-standing gap with US Treasuries and caught global investors off guard. That move matters because Japanese yields have been anchored for years, acting as a stabilizing force for global rates. Once that anchor started to slip, spillovers into US yields became harder to ignore. The comparison shows why markets grew uneasy, as higher Japanese yields threatened capital flows, currency dynamics, and global bond positioning. In short, the chart makes clear that stress in Japan's bond market quickly turns into a global rates issue rather than a regional one. While the headline screamed uncertainty, the market's internal story was surprisingly constructive. Small caps kept showing real strength and even notched fresh records during the week. That matters because it hints at broader participation beyond the usual mega cap leadership. Now, here's what matters. When breadth improves, dips can get bought faster, even in a headline-driven market. But it also raises the stakes because a sudden rates jump or trade scare can hit smaller companies harder if momentum flips. The latest data did not give markets a clean answer, but it kept the rate debate firmly alive. Economic indicators avoided a sharp slowdown, yet they were not soft enough to clearly justify imminent rate cuts. This chart shows why the Fed debate refuses to settle down. Headline CPI has clearly cooled from its 2022 peak, helped by easing energy and goods prices. Core CPI has also come down, but at a slower and stickier pace, especially in services. That gap matters because the Fed focuses heavily on underlying inflation trends, not just the headline relief. The recent leveling in core inflation explains why policymakers remain cautious despite better-looking top-line numbers. In short, inflation is moving in the right direction, but this chart shows it is not yet convincing enough to fully unlock aggressive rate cuts. This chart shifts the focus from inflation to rates expectations embedded in the yield curve. The spread between the 2 years and 10 years Treasury yields remains deeply inverted, signaling persistent caution about the economic outlook. Short-term yields staying elevated reflect markets pricing in a Fed that is not ready to ease quickly. Meanwhile, longer-term yields suggest investors still expect slower growth ahead. The lack of re-steepening tells us confidence, and a soft landing is fragile rather than firm. Together, the curve reinforces why markets remain stuck between hopes for cuts and fears of higher for longer. Zooming in on SPY, it kept respecting that rising trend channel all week, even while headlines tried to shake people out. You can see price rotating higher inside the channel, with pullbacks stalling well above the 50 days moving average, a classic sign that buyers are still stepping in. The catch is the tighter this channel gets, the more violent the eventual break tends to be. That is exactly why traders felt edgy even on green days. One more thing on SPY, the TTM squeeze stayed on as ranges compressed even further. That coiling action screams indecision, but it also tells you energy is building under the surface. In a week full of policy noise and rate nerves, this looks like the market holding its breath. All it takes is one real catalyst, and the move usually is not subtle. Meanwhile, the Fibonacci retracement levels on SPY highlight just how clean this consolidation really is. Price held above the key retrace zone from the prior impulse leg, signaling that sellers never gained real control during the week. But here is the pressure point. If headlines or rates force a break below these levels, sentiment could flip fast, because traders know this calm structure can snap violently. Shifting over to QQQ, the Nasdaq 100 ETF, tech stayed firmly in control even with the macro backdrop wobbling. Trend strength remained confirmed through the week, with buyers defending higher lows while rate chatter and trade headlines tested nerves. That tells you mega cap growth still got treated like a safer place to hide when uncertainty flared. The uncomfortable part is this leadership is strong but crowded, and everyone knows it can unwind fast if sentiment cracks. Now shifting focus to momentum inside QQQ, you can see stochastics pushing higher fast, reflecting aggressive dip buying in tech. That surge shows traders were still chasing upside despite all the macro crosswinds during the week. But here is the risk signal. When momentum heats up this quickly in a nervous tape, it leaves the index vulnerable to sharp pullbacks if sentiment suddenly turns. So, zooming out on QQQ, the Nasdaq 100 ETF, the volatility compression is getting impossible to ignore as the squeeze tightens again. This is what it looks like when uncertainty hits an extreme and nobody wants to overcommit ahead of the next catalyst. In a nervous market, a coil like this rarely resolves quietly. Traders are basically sitting on a pressure cooker and waiting for the lid to rattle. Looking ahead, this compressed volatility on QQQ is flashing a clear warning sign going into the next week. The tighter these ranges get, the more unstable sentiment becomes, especially with traders hypersensitive to rates and policy headlines. But here is the takeaway. Tech strength is still intact, yet the market is clearly coiled, and any surprise could trigger a fast and emotional move in either direction. Shifting gears to IWM, the ETF that tracks the Russell 2000 and gives us a read on small cap risk appetite. The chart shows trend strength still confirmed, which tells us money continued rotating into smaller companies during the week. That matters because small caps tend to lead when investors feel confident about growth, even in a noisy macro environment. But here is the emotional layer. This move feels bold, not comfortable, as traders pushed risk while keeping one eye on rates and headlines. The uptrend is real, yet the tension underneath suggests this part of the market is being stress tested. Digging deeper, the stochastic signal on IWM flashed a bearish cross from overbought territory, hinting that momentum started to cool. That lines up with how aggressively small caps ran into the week, leaving little room for error if sentiment wobbles. But here is the tension. This does not kill the trend, it just raises the odds of a pause or shakeout before the next decisive move. To wrap the small cap picture, IWM's RSI slipping back below the overbought zone confirms upside momentum cooled into the end of the week. That fits the idea the risk appetite is still there, but it is getting more selective and less reckless. Small caps are not breaking down, but you can feel traders tightening risk because nerves are still running hot. Turning to rates, the focus shifts to TNX, the US 10-year Treasury yield, which quietly kept trending higher through the week. The chart shows trend strength still confirmed, reinforcing that bond markets were not fully buying into an imminent easing narrative. That matters because rising yields tend to pressure risk assets, even when equities try to stay resilient. But here is the emotional pulse. Yields grinding higher in the background kept traders uneasy, reminding everyone that the common stocks could be fragile if rates suddenly accelerate. Meanwhile, the yield chart shows volatility sitting unusually low, with the ATR percentile pinned near the bottom. That common rates looks deceptive because markets were clearly uneasy despite the lack of big daily swings. But here's the warning sign. When bond volatility compresses like this during a tense macro week, it often precedes a sharp and uncomfortable move. Looking at momentum in TNX, the MACD rejected the zero line to the upside. A clean sign yields still have upward pressure. That fits the week's mix of policy uncertainty and the sticky inflation debate. And as long as yields keep pushing like that, equity traders know the floor under risk assets is not guaranteed. It is the quiet kind of pressure that suddenly turns loud. So, shifting from rates to currencies, the US dollar index rolled over to a 20 days low during the week. That drop fits with defensive positioning getting unwound after the trade scare cooled. A softer dollar gave risk assets a little breathing room, but it also showed how fast the crowd can flip when confidence wobbles. This is not calm risk on, it is fast repositioning. Closing out the dollar story, we got a clean range expansion day to the downside, which is the market saying the move suddenly had real momentum. The break under the prior trend channel shows sellers briefly took control as those defensive positions got unwound. And the vibe here is important. This was not a calm, confident shift. It was fast repositioning. When the dollar moves like that in a tense tape, it often leaves everything else jumpy for the next couple of sessions. Wrapping it up, the dollar also slipped out of its prior trend channel, confirming a short-term regime shift. That technical break shows how quickly conviction faded once defensive trades were unwound. But here is the emotional takeaway. When the dollar loses structure like this in a tense market, it often fuels short bursts of risk-taking while keeping everyone on edge. Switching over to commodities, gold takes center stage through GLD, the ETF that tracks the metal and reflects safety demand. Price pushed to fresh highs during the week with trend strength clearly confirmed as investors look for protection amid political noise and rate anxiety. Even with stocks holding up, that steady bid for gold tells you nerves never really left the room. This rally feels more like caution buying than celebration. Looking closer at gold's momentum, trend strength remained firmly confirmed, showing buyers stayed in control without hesitation. That persistence suggests demand was steady rather than emotional chasing. But here is the tension. When gold runs this strong alongside resilient equities, it usually signals underlying anxiety that has not fully resolved. Now we start seeing a bearish RSI divergence on GLD, which is basically a warning that upside momentum is not accelerating anymore. That does not force a drop, but it does make the rally feel more fragile up here. When the safety trade shows even a hint of fatigue while fear is still in the air, markets can get twitchy fast. Shifting focus to energy, oil comes into view through crude futures, which started to show renewed strength late in the week. The chart confirms trend strength turning positive, helped by stabilizing demand expectations and easing fears of an abrupt global slowdown. But here is the emotional contrast. Oil trying to recover while gold stays strong tells us the market is torn between growth hopes and lingering caution. Zooming out on oil, price also managed to reclaim and hold above the 50 days moving average. That is an important technical step because it signals short-term control shifting back toward buyers after a long period of weakness. But here's the emotional takeaway. This recovery looks tentative, with traders still questioning whether growth can truly reaccelerate. Wrapping up commodities, the bigger picture for oil still sits under the shadow of the longer-term death cross context. That tells us this bounce is happening inside a market that has not fully repaired its structure yet. But here is the emotional signal. Traders are willing to probe the upside, while still knowing this move can fail quickly if growth fears resurface. Stepping into high beta, Tesla is the real-time stress test for risk appetite. The chart shows momentum trying to turn back up, with stochastics lifting after that sharp pullback. This bounce reads more like bargain hunting than full-blown conviction, especially with rates and policy noise still hanging over the tape. You can feel the mood in the price action, people want to buy dips, but nobody trusts that volatility is gone. On the flip side, Tesla's broader trend is clearly losing some punch despite the bounce attempt. The chart still sits within a fragile structure, showing that longer-term confidence has not fully returned. But here is the emotional signal. This is the kind of setup where hope and hesitation collide, keeping traders quick to take profits. Wrapping up the Tesla red, the chart also highlights how recently the stock experienced a deep pullback, with only a limited number of days since the last 10% drawdown. That context matters because it shows volatility is still fresh in traders' minds. But here is the emotional takeaway. This is not a calm accumulation phase. It is a market still scarred by sharp moves and quick reversals. Fast forward to next week, and the whole market is basically holding its breath for the Fed rate decision on Wednesday, January 28th at 2 p.m. Eastern. This is the kind of setup where even a no-change decision can still hit like a shock, because positioning is already tense after a headline-heavy week. The Fed statement drops right with it, and the first move usually happens before anyone has even finished the first paragraph. That is why traders react first and read later, and why liquidity can vanish in a heartbeat around the release. If the language leans higher for longer, risk gets repriced instantly. If it leans patient, you can get a nasty relief rip that still feels fragile. The real danger is what comes next, the FOMC press conference at 2:30 p.m. Eastern, where every sentence can whip rates around. Markets will be listening for whether Powell sounds confident, cautious, or boxed in, and that tone can matter more than the decision itself. Even if the first reaction looks clean, the press conference is where the calm can break and where the week's nervous energy can explode into a second wave. This is the part where the market stops trading the number and starts trading the vibe. SPY is still holding that rising channel, but the action felt tight, jumpy, and totally headline sensitive. That is the real takeaway. The trend is up, but confidence is thin and the market reprices risk on every new twist. If this channel snaps, the unwind can be fast. If it holds, the squeeze can launch just as violently. Stay disciplined into the Fed week, because this tape is one surprise away from flipping the mood. Please hit subscribe if you want the next breakdown the moment it drops, and drop a like if this helped you stay grounded through the noise. See you next week, stay sharp, manage risk, and stay tuned.